Now, in terms of why it's important to the company, we just think it's an easier way of doing business. It's also critically important as we change our manufacturing operations and change the way we physically do things out in the shop floor. We have to change the way we keep track of it. So that's what we call lean cost management. And when you think about lean cost management, it's really tools to provide users or the people that are changing the physical operation in the plant, the tools to allow them to understand what's really going on. Right now, accounting is a totally different language. It's a foreign language to the folks in the shop that have to use the information to improve. And how could they improve anything if they don't understand it? So we need to make it easy, we need to make it actionable, and we need to make it timely. And that's what lean cost management is all about. Again, continuing on the same theme, we want people to understand how to keep score. So if you're a sports fan, you go to a ball game, you always know the score, you always know how much time is left in the game, you always know what yard line you're on, all those kinds of things. Imagine if you went to a ball game and you just sat there and you didn't know any of that. It'd be pretty frustrating, and I think that's the kind of environment traditional accounting provides for the folks that have to use the information. They don't know the score, they don't know where they are, they don't clearly understand the goals, and yet we give them numbers at the end of a month, usually 2 weeks after, and say make it better. So it's going to make life easier for them, which is critically important, and it's also going to give them ownership. We want to make a whole bunch of mini businesses and entrepreneurs in the shop that can improve the business. So if we simplify it, it's going to help the business. Lean accounting has changed the way decisions are made. For example, when we design things or evaluate costs, what we typically do is try to get the lowest bill of material cost for every end item. And so what you're looking at is, in isolation, one small piece of the cost of a product, and then you add those all up and you get the total cost. When we do a value stream map or value stream costing of the operation, we're really looking at the total system cost. So for an accountant, to me, that is the greatest thing, because now we can make decisions on how we optimize the system. Now, instead of how we optimize just one small piece of it, we may be just transferring cost to another element of the operation. As an example, and you might see later our other plant, we used to purchase material from Budapest, Hungary, one of our divisions, and the thought was that if we buy those end items over there and import them to the U.S., it would be cheaper. After we did value stream mapping and value stream costing and took into account total system costs, we actually moved some of the operation to the U.S. So it does change decisions, and it can change them quite dramatically.
Great.
Value stream costing is going to mirror image what actually goes on in the plant. We're looking at average costs for families of products rather than trying to get the cost of each end item to the 1,000th of a penny, which when you think about it is kind of ridiculous. And what's further ridiculous about it is when someone reads the traditional cost accounting report and they see the cost and they look at it and they see 4 or 5 or 6 decimal places to the right of the decimal point, you're sending a message that, wow, we really know what this cost is down to this level. And it's really wrong, because we don't. The traditional cost accounting is composed of a lot of assumptions, a lot of allocations, a lot of things up front that people accept as gospel. When we get to value stream costing, we're really looking for a family of products. What's the average cost? And we look at it in terms of total labor, total variable cost, total fixed costs, and we really understand the operation and the system much better. One of the critical things is that we have to begin to realize that financials only get better when physical changes take place. You can only do financial engineering for so long before the reality catches up. So what we do is when we value stream an operation, we understand what is going on much better. We understand the critical components. We understand the bottlenecks. We understand where we have to make improvements. And based on that value stream, we determine those critical elements that we want to keep track of. And they'll go in what we call the top half of the box score, the operational elements of the business. In the bottom half, we put the financial parameters, the usual things, sales per employee for productivity. We'll put inventory turns. We'll put, in our case, variable margin, gross margin, some of the traditional items. But we put the operational items on top because we feel that's where people have to focus. If they improve the operational scorecard, the financial scorecard will get better. The flip side is if we're making improvements on the operational side and the financial scorecard isn't getting better, we also know we picked the wrong operational parameters. And people can relate to that because at the end of the day, they want to know, what do I have to do to make this business better? And they want to be able to link what they do to the financial results. And we feel the scorecard helps them do it. So it's a tremendous tool to help people understand the business and to see the fruits of their effort manifest in better financial results.